Ind AS 37. Provisions, contingent liabilities, and contingent assets. What is meant by liability? Liability is a present obligation arising from past events, settlement of which is expected to be result in an outflow of resources. What is meant by obligating event? It is an event that creates legal or constructive obligation that results in an entity having no realistic alternative exists to settle that obligation. What is a legal obligation? Legal obligation is an obligation that arises from contract or legislation or law. Example, X Limited entered into a contract with Y Limited for supply of goods. If any party breaches the contract, it has to pay 50 lakhs as penalty to other party. X Limited breached the contract. The breach of contract is a legal obligation and X Limited must settle the obligation. Next, constructive obligation. What do you mean by constructive obligation? Constructive obligation is an obligation that arises from past practice, policy, specific statement indicated to others to accept the responsibilities, and as a result of this, it has created a valid expectations for other parties. Example, pollution caused by entity due to which nearby public has protested. The entity promised to clean the river. No legislation requires so, but since the company has promised and created a valid expectation, it is a constructive obligation. Next, provision. What do you mean by provision? Provision is a liability with uncertain timing or amount. A recognition of provision. A provision shall be recognized only when an entity has a present obligation, either legal or constructive, as a result of past event. It is probable that an outflow of the resources will be required and reliable estimate can be made. So, to recognize a provision, there should be a present obligation arising from past event and outflow of resources are probable. A reliable estimate can be made for outflow of resources. There should be a past event which leads to a present obligation and gives rise to a liability for which provision is made. Example, in respect of warranty provision or warranty obligation, past event is original sale. In case of a contamination of land, past event is original contamination. Only those provisions are recognized for which entity has no realistic alternative settlement exist rather than settling it. That means no realistic alternative settlement exists. If entity can avoid such expenditure by its further actions, then no provision is recognized. That means if alternative settlement exists, then provision need not be created. Where details of the proposed new law are yet to be finalized, obligation would arise only when the law is virtually certain to be enacted. Measurement of provision. Methods by which provision may be measured. First one, best estimate. Second, present value. Third, uncertainties, risks and uncertainties. Fourth, future events. Fifth, expected disposal of assets. First one, best estimate. Amount of provision should be the best estimate if provision is measured for large population of items, example, customer refunds, warranties, etc. Consider the probability of each item. Where there is a single item, that is individual item, consider most likely outcome. Next, present value. It will be used only when time value of money is material. The amount of provision should be at a present value. Discounting factor will be pre-tax. Third, risks and uncertainties. All risks and uncertainties that would result in increase in the amount of provision should be taken into account while measuring a provision. Future events. Future events that may affect the amount of provision should be considered only when there is a sufficient objective evidence available that they will occur. Example, cost of restoration of site may be reduced by future changes in technology. If evidence of such change is available, reduce the provision. If there is no evidence available, no change in the provision shall continue. Next, expected disposal of asset method. No provision for gain on expected disposal of asset is recognized. For example, at the end of 2021, an entity is demonstrably committed to the closure of some facilities, having drawn up a detailed plan and made appropriate announcements. The expected impact of the plan is as follows. 2022 committed closure cost will be 10 lakhs. Gain from sale of property in 2023 it will be 2 lakhs. The provision required at the end of 2021 is 10 lakhs. It is the committed closure cost that will be required in 2022. The expected gain on the sale of the property is dealt with separately under the derecognition criteria as per Ind AS 16. So gain from sale of property will be dealt as per Ind AS 16. Next, use of provision. It can be used only for expenditure for which the provision was originally recognized. It cannot be settled against expenditure that does not relate to the provision. Change in provision. Provision need to be reviewed at every year end and adjusted to reflect the current best estimate. If it is no longer required, it should be reversed. Once the amount of obligation is crystallized and there is no uncertainty associated with an obligation, the liability is no longer a provision. The same should be reclassified as an element within liabilities. Where discounting is used, the carrying amount of provision increases each period due to the passage of time. This increase in provision in the balance sheet and it is recognized as finance cost in P&L. The journal entry will be finance cost account debit to provision account. Next, future operating losses. No provision is to be recognized as it does not meet the definition of provision. So for future operating losses, no provision will be created because it does not arise from the past event. Also, it is not an obligation because the same cannot be avoided by closing the business. Next, contingent liability. Contingent liability is a possible obligation that arises from past events whose existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future events not within the control of the entity. Or it is a present obligation that arises from the past events but is not recognized as a provision or liability because it is not probable that outflow of resources will be required or amount cannot be estimated reliably. So contingent liability may be possible obligation or a present obligation. Both are arising from past events. Possible obligation, which is not within the control of the entity, depends upon occurrence or non-occurrence of one or more uncertain future events. In case of present obligation, outflow of resources are not probable or amount cannot be estimated reliably. In such a case, it will be considered as contingent liability. Treatment of contingent liability. Contingent liability is not recognized in balance sheet, it is only disclosed. No disclosure is required if possibility of outflow is remote. So contingent liability is only disclosed, it will not be recognized in balance sheet. Where the entity is jointly and severally liable for an obligation for own shares, create a liability or provision. Where the entity is jointly or severally liable for an obligation for other shares, create contingent liability if not remote. For remote cases, contingent liability will not be recognized or disclosed. At the end of each year, contingent liability is to be reviewed. If it becomes probable that outflow is required, then it can be reliably estimated. Then provision is recognized and contingent liability is removed. So, at the time of review, if it becomes probable that outflow is required and it can be reliably estimated, then we need to recognize the provision and remove the contingent liability. Next, contingent asset. Contingent asset is a possible asset that arises from past events whose existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future events not within the control of the entity. So contingent asset is a possible asset which is not within the control of the entity. Depends upon occurrence or non-occurrence of one or more uncertain future event. How do you treat contingent asset? If inflow is virtually certain, it becomes an asset. So recognize asset. It is not a contingent live asset. So recognize it as a normal asset. If inflow is probable but not virtually certain, contingent asset, it will be considered as contingent asset, but it will not be recognized. However, disclosure is required. Disclosure regarding this contingent asset is required. If inflow is not probable, in such a case, contingent asset is neither recognized nor disclosed. Next, if likelihood of outcome, likelihood means probability of outcome is virtually certain, that is greater than 95% probability. In case of contingent liability, recognize the provision. In case of contingent asset, recognize the asset. In case of a likelihood of outcome is probable, that is 50% to 95% of the probability. Contingent liability, recognize the provision. In case of contingent asset, disclose about the contingent asset. Next, in case of likelihood of outcome is possible but not probable, that is 5% to 50% probability. In case of contingent liability, disclose the contingent liability. And in case of contingent asset, no disclosure is required or permitted. In case of a remote probability, that is less than 5% probability, no disclosure is required. In case of contingent liability, in case of contingent asset also, no disclosure is required. Reimbursements. In this case, some or all of the expenditure required to settle a provision is expected to be reimbursed by another party. Recognition criteria. Reimbursement is recognized only when it is virtually certain that such reimbursement will be received, and if not virtually certain, then disclose the reimbursement. If virtually certain, recognize it, otherwise, disclose it. Accounting treatment for reimbursement. Reimbursement shall be treated as a separate asset in balance sheet. That is, provision liability and reimbursement asset will be shown separately in balance sheet. In P&L, provision expense and reimbursement income can be netted off and presented. The amount of reimbursement shall not exceed the amount of provision. The important point is amount of reimbursement shall not exceed amount of provision. Next, onerous contracts. Onerous contract is a contract where unavoidable cost of meeting the obligation exceeds economic benefits to be received under it. Accounting treatment of onerous contract, it will be recognized as provision. The unavoidable cost, that is amount of provision, is the cost of existing from the contract, which is lower of the following: cost of fulfilling it and penalties, or penalties arising from failure to fulfill it, whichever is lower. So how to calculate unavoidable cost? Cost of fulfilling the contract or penalties arising from failure to fulfill the contract, whichever is lower, will be the unavoidable cost. Provision should be created for such amount. Important point is both incremental cost to fulfill a contract and allocation of directly attributable cost will form part of cost used for determination of onerous contracts. Para 69 has been amended by replacing assets dedicated to contract to assets used in fulfilling the contract. This amendment requires to take into consideration impairment loss on all assets whose cost will be considered in assessing the contract as onerous. These amendments are prospective from 1st April 2022 with cumulative effect recognized in the opening balance of retained earnings or other component of equity as appropriate. Comparative period financials not to be restated. So it will have a prospective effect, the cumulative effect recognized in opening balance of retained earnings. That means any adjustments will be made in the opening balance of the retained earnings or other component of equity as appropriate. Next, restructuring. What is meant by restructuring? Restructuring is a program that materially changes the scope of business or manner in which business is conducted. Example, corporate restructuring, that includes internal restructuring, external restructuring, etc. Accounting treatment of restructuring. A provision for restructuring cost should be recognized only when the recognition criteria of the provision is met. An obligation should arise to recognize the restructuring cost as provision. A constructive obligation arises when entity has a detailed formal plan and entity has raised a valid expectation that will create out that will carry out the that it will carry out the restructuring. Entity has detailed formal plan. The plan should state business concern, principal location affected, approximate number of employees who will be compensated for terminating their services, expenditure that will be incurred, date on which plan will be implemented. Entity has raised a valid expectation that will carry out the restructuring. Valid expectation is created when it has started to implement the plan or when the plan has been announced to those affected by it. So, valid expectation will be created when implementing or announcing time. Next, restructuring provision amount. Restructuring provision amount includes only the direct expense arising from restructuring, which are both necessarily entailed by the restructuring and not associated with the ongoing activities of the entity. So restructuring provision includes restructuring cost. It should not be associated with ongoing activities. But restructuring provision does not include expenditures such as retraining or relocating continuing staff, marketing, investment in new systems and distribution networks. These expenses relates to future conduct of the business and are not liabilities for restructuring at the end of the reporting period. So restructuring provision does not include these expenses, retraining, marketing, investment in new systems.